Most people think Warren Buffett makes his big money only by picking great stocks. People often talk about his investments in Coca-Cola, See's Candy, and many other well-known companies. Friends, but honestly speaking, none of these popular investments are my favorite bets. My favorite bet of Buffett is when he made over $15 billion in Japan without investing any capital. Yes, you heard it correct, without investing any capital. Now let's explore how Buffett earned that much of money without using his own capital and why he chose to invest in Japan only instead of US, and how he can spot such unique or anomaly stocks ourselves. This will help us uncover smarter investing ideas and spot hidden wonderful opportunities that others often overlook. If you are curious to learn more about stock market, feel free to check my free course on stock market trading. Link is in the description. So without wasting much time, let's start the main topic. In 2019, Warren Buffett identifies 5 different companies in Japan for long-term investment. These companies are from different sectors like energy, metals, shipping, food, retail chemicals, and global trade. All these companies are old, stable, cash-rich, and run on predictable business cycles. So Buffett realizes investing in these companies carries almost zero risk and a good probability for huge growth in the future. You might ask how and why. The reasons are pretty simple, friends. They had decades of profits. They were profitable since many decades. They had strong cash flows. So every year they had a very good strong cash flows. Low valuations. They were available at very less valuations. They were paying high dividends. Every year those companies were paying 8 to 9% dividends. Global diversification. All these companies operated diversified business across the world. Lastly, government support in many sectors. Okay, all these companies got the support of Japanese government. So because of all these reasons, Buffett thought that investing in these companies is a wonderful opportunity for any investors. But still, Buffett didn't invest blindly. Warren visited Japan. He met all the CEOs of these 5 companies. He checked their work culture. He checked their capital allocation. Finally, he liked what he saw. Now, this one quality separates Warren Buffett from other investors across the world, because he didn't invest his own money or Berkshire Hathaway's money into these 5 companies for the long-term investment, because he noticed that interest rates for loans in Japan is only 0.5%. So he raised $5 billion as a loan at 0.5% interest from these Japanese banks and invested that money in these 5 companies. Friends, interest rates in Japan are very low because the country has been experiencing deflation for many years. Deflation is opposite of inflation, okay? So Japan has a strong culture of saving money, but investing behavior is less across its people. Now, all these companies where Buffett invested money started paying dividends at 8% every year. On one hand, he took the loan at only 0.5% interest and he was getting 8% returns every year. That is the intelligence of Warren Buffett. Friends, these firms were not just growth stocks, okay? They were cash flow machines for Warren Buffett. Within a few years, his capital doubled 5 billion to 10 billion, and now he started to get dividends not for $5 billion but for his $10 billion, because equity also doubled, right? Anybody could borrow 5 billion at 0.5%, but only Warren Buffett has the vision and capability to shortlist these kind of wonderful opportunities. Right now, the value of these investments is over $25 billion. This is one of the Buffett's cleanest and safest trades. A rare moment where the risk was low and the returns were ultra high. This is real investing. Two things are important behind Buffett's success, friends. So number one is identification of a strong business moat. Number two is recognizing the right valuation levels. So number one, identification of a strong business moat. To be honest, I admit that I don't have the capability or knowledge to identify of a strong business moat like Buffett does. I can give you a simple example. Let's say there is a small town. That small town has only one hospital. So that hospital has a moat, right? Because opening of another hospital, it takes some time. It is little tricky. So until another hospital opens, so that particular hospital has a moat, right? That is moat. In India, some of the good companies with high moat are, for example, Titan or Reliance or Adani, something like that. So I can give a simple explanation about the identification of a strong business moat. But in this video, now I will go further how to recognize a right valuation metric for any companies. Let's say one new company is making a debut in IPO. So you might be tempted to invest in that company, but you don't know the levels. Let's say they are quoting at 500 rupees per share or 600 rupees per share. You don't have any mechanism to say whether that 500 rupees, investing at 500 rupees is really worth or not. So in this video, I will be explaining how to evaluate any company or how to calculate the intrinsic value of any company using simple valuation metrics. Friends, intrinsic value of any company can be calculated using DCF. So it is very, very helpful. Let's say a company is earning 1 crore rupees in this year and it is earning 2 crore rupees in the next year. So if you want to buy a company, there should be a value, right? You cannot buy the company at 1 crore rupees or you cannot buy the company at 3 crore rupees. So there should be some valuation to buy the company, right? So DCF gives that kind of valuation. So DCF is very, very simple. For example, now how do we why you can ask, why do we need a DCF? So it's very simple, right? Because in most of the cases in markets, the price is dependent upon the mood, people's mood, right? If there is any negative sentiment, price will fall. If there is a positive sentiment, the price will go up. But the real value is something different, right? So you might ask why. Let's say very simple, there is a big building, there is a big commercial building, only one person owns that company. So the price of that big building will be constantly same, for example, for a couple of months, right? For example, let's say the big building cost is 80 crore rupees. If you come tomorrow, the big building cost will be 80 crore rupees. For next few weeks, next few months, the price of that particular big building is 80 crore rupees, right? But let's assume there is a company that owns that big building. In that case, that shares of that company is traded in the market and people have different perceptions, right? They might think the big building or the company will make huge profit, or they might think the company will not make huge profit. So they buy and sell, right? So definitely the market value of that company when listed, it will not be 80 crore rupees, right? It will fluctuate. It can go up to 120 crore, 150 crore. It can come down to 30 crore, 40 crore. So that is different, right? So market price is not the exact value of that company, right? That's why Buffett says the price is what you pay, value is what you get, right? So because of all these reasons, if you want to buy a business, like if you want to buy a company or if you want to invest in a company, you need to know the intrinsic value, know the exact share price worth fundamentally before investing in that business, right? So DCF is one such tool. It help you to come up with those numbers. Okay, so it's very simple. You might ask, what is DCF? So DCF is very simple. It is just a future cash flows converted into today's value. For example, we will take all the future earnings and we will convert into today's value. We'll sum up everything and we will say this is the EV, overall value of the company. Okay, so that's one thing. Now, key idea. Okay, you might ask, why do we need DCF? Again, it is very simple. Money today is more valuable than the money tomorrow, right? Let's say a company is earning 2 crore rupees next year. That doesn't mean we should pay all the 2 crore rupees right now, right? Because right now and the next year there is a 1 year duration. The value of 2 crore rupees now is different. The buying power of 2 crore rupees now is different. The same 2 crore rupees has a lesser buying power after 1 year, right? Because of the inflation. Also, we should not forget the opportunity cost, the risk we take. We might not get 2 crore rupees earnings in the next year, right? So because of all these things, we need to reduce the value of that future earnings, and then we need to calculate. So DCF does it automatically, not automatically, we need to give the values, but it does it more efficiently. Okay, now what are the things we required for this analysis? So we need estimate free cash flow. In a business, we need to see, or we need to get how much profit it is generating at the end of the year. That is one thing. We need to predict the growth in that company for a few years. Let's say you decided to invest in XYZ company which is coming in IPO. So you need to, based on the study, you need to predict a growth. Let's say the company will grow at 10% every year, or the company will grow at 8% every year, or the company will grow at 15% every year. If you look at the fundamental details in screener.in, you will get some clue, like ROE is this much, ROC is this much. I will show all those things in a while. Our net profit is increasing this much. All those things available in screener. So next is, you need to add a discount rate. How much discount rate you need to add after the growth? Okay, that varies actually. Anyway, I will show you that in a while. So basically, people will give anywhere between, because the fixed deposit will give 8%, 7 to 8% in India, right? So you should add minimum that value. So somewhere between 8 to 10% minimum we should give as a discount rate. Next, you need to add terminal rate. So when I say terminal rate, this growth projection is only for 5 years usually. So the terminal rate is the growth rate after 5 years, okay? Because the company might grow forever, right? So we will give the terminal rate after 5 years. Usually it will be quite less compared to the growth rate, because you don't know what will happen to a company after 5 years. So we give less value to terminal rate compared to growth rate. Now you need to include all the cash equivalents of the company and debts of the company, because liquid cash also is like an asset, right? At the same time, you need to include debt also, because debt can it will have a huge impact on the performance of a company, right? So we should include the debt as well. Now after all these things, we need to add everything, and we should discount everything back to today and compare with the market price. This is how a DCF works. Don't worry, I will explain everything very easily. So what we do is, we'll go to a screener. For example, I will go to screener. I want to calculate the intrinsic value of a company. So let's say Titan. So Titan is a favorite company for Rakesh Jhunjhunwala. We will see whether the Titan is available at an attractive valuation or not. There is no doubt Titan is a good business. But as most investors or Warren Buffett say, good business is one thing, but we need to enter at the right valuation, which means at very less price. That is the second thing. If you enter a good business at a higher valuation, you will not be able to make profit, right? Because the company will take more time to increase in value, even if it get good earnings. So we need, for example, we need all these things, free cash flow. This is FCF. Okay, so we need these details. Okay, so all these things are available in charting. So basically, this is the free cash flow. It's a negative thing for the last year. So they might have done some investment. For example, if you go here, you will get that information, or they might have gone through some loss also. So they there is something, some loss happened for this company. So for time being, I will take another company which is not negative, okay? Because when the company has a negative cash flow like this, we need to dig deeper whether they have done a real investment. For example, if the company cash flow is negative, let's say they earned 100 crore rupees, but they have taken a loan of 200 crore rupees and they are starting a new facility which will be productive after 2 or 3 years. In that case, we should not consider now the company is negative, because even though they have earned 100 crore rupees, they have invested 200 crore rupees, right? So it is something like that. So I will look for some other company where this cash flow is not negative. Let's say I will take TCS. Okay, so if I take TCS, okay, see here, free cash flow for the last year is close to 45,000. Okay, so one way is we can take this as it is, but Warren Buffett, Charlie Munger suggests that we should take the average of last 3 to 5 years. Okay, so if I take last 1 year, it is 45,000 crore. If I take 3 years, it is close to 1,25,000. So definitely it is close to 40. If I take 40,000, it comes around 1,20,000, right? So 45 is acceptable. If I take 5 years, again it is acceptable, right? So free cash flow is 45,000 something. So I will take 40,000 to be safer side. I will take 40,000 crore as the free cash flow. Next, growth rate. So what is the growth rate? We need to anticipate Tata Consultancy. So we can check for ROC or ROE. They are quite good. If you look at, for example, growth in terms of sales every year. For example, this is the sales. For example, if you look at this and if you look at this, this is the yearly growth. Okay, so if you compare this, let's say if you take the average of this, okay, for example, the difference of this is, there are many ways people anticipate growth, based on the net profit, based on the sales, everything. So we should take something, right? Let's say we'll take net profit. Okay, so net profit is close to 2,500, 2,600 increase, right? So now what I do is I will check growth in terms of net profit. Okay, 2,600 crore is the difference of these two. Okay, 2025 and divided by 46,100. 99, I make it 100. Okay, if I make it into 100, see the growth is 5.6 or 6% in terms of net profit. Okay, if I look at the growth in terms of net profit, it is 6%. So let's say if I take it here, it is close to the same thing, right? Close to 4,006%, which means from net profit perspective, it is growing 6 to 7%. Or you can also check here return on equity or compounded sales growth. You can see here, right? Sales growth is this much. Compounded profit growth is this much, stock price growth is this much. So you can take any of these things or combination of these things. So approximately sales growth is 10%, profit growth is 10%. So maximum it can grow at this scale is only 10% or maximum 11-12%. Okay, so even though this ROCE and ROE looks attractive, the maximum growth, overall growth TCS can get is 10%. So I will take growth rate is 10%, default it is there. Okay, so discount rate I will also take maybe, for example, I need expectation 9%. Okay, FD is around 6 to 7%. So I will take discount rate is 9%. So which means I expect minimum 9% value to my investment. Okay, so terminal growth is 5%, which means after 5 years, this is the growth rate for the next 5 years, 2025 to 2030. So I will assume the TCS will grow with 5% growth after 2030. Okay, this is the decent estimation. Now what you can do is number of outstanding shares. Okay, so if you divide market cap by current market price, you will get number of shares, but that information is also available here. 362 crores, for example, I will make it 362 crores. Okay, so you can check here. For example, if I divide this market cap 11,19,943 divided by the current market price 3095, we get that information 361, right? 362 close to. So 360 crores it is there, right? 360 crores. Now cash, what is the cash? It has cash means cash, liquid cash. So it has 14,453. Okay, so 14,453 crore cash. And debt, it has 10,932 debt. 10,932 debt. Okay, these are the details about the TCS company, right? Now there are many online calculators are available for to calculate the intrinsic value. But if you go to ChatGPT, you can ask, for example, calculate the intrinsic value of this company. ChatGPT does it for you, so no need to go to any online calculator. If you give this information, it will give you the intrinsic value of the company. Okay. By the way, this is not a buy or sell recommendation, friends. This is just I'm explaining how to calculate the intrinsic value of a company so that we manage it for the long-term investment. See, what it does is it calculates the first year. So FCF free cash flow is 40,000, right? So growth rate, I'm assuming 10%, discount is 9%. It will calculate how much it will earn for the next 5 years and going forward and all. Okay, so this is for the next 5 years, I guess. And then this is the terminal value and discount factors, present value of terminal. So overall enterprise value, which means TCS worth is this much. So it earns 40,000 crores approximately every year, right? So it is anticipating the overall value of the company is this much. Okay, equity value is, it's very simple. What it does is it will add EV plus cash. What is the liquid cash it has? Minus debt, it subtracts the debt, divided by number of shares. Okay, equity value is this much, equity divided by number of shares. So intrinsic value of the TCS per share is 4,343. If you look at the current value, 4,000, it's 395, 3,000, right? So which means TCS is available below the value. The real value of the TCS is this much, right? 4,400 something. So even if you reduce the growth rate, let's say I reduce the growth rate by 8%. I don't think TCS will grow at 10%. I'm assuming TCS will grow at 8%. So in that case, okay, calculate the intrinsic value. If you assume just 8% growth, you can see it will give you the equivalent. It will calculate everything and it will give you the intrinsic value. For example, intrinsic value, even if you assume 8% growth, is 3,546. So currently it is trading around still 3,000 something. Okay, it is still available than the intrinsic value, the real value. Okay, Warren Buffett identifies the intrinsic value is the real value. So TCS is available at a cheaper price. That doesn't mean you should invest in TCS. Once again, I'm saying this is the way we will calculate the intrinsic value of a company. Let's say there is a new company which is making a debut in IPO. So you don't have to invest blindly in it. You get all this information. Let's say you get free cash flow. You get free cash flow information in their website. You can assume or you can check how much their growth rate in last few years. You can give discount rate on your own. You can give 9 to 10%. By default, terminal growth you can give 5%, and you can check these details. So how much cash they have, how much outstanding shares they have. So if you give this information, the ChatGPT will give you what is the intrinsic value of the company. Then you can decide whether to invest in that particular company or not. So we will check for one more company. For example, let's say we will check for one other company. Let's say what stock is trending today, and then we will check for that particular company. So Hero MotoCorp is trading at 3.3% today. So we'll check Hero MotoCorp. Okay. So if you go to Hero MotoCorp, okay, free cash flow is 3,400 something. For 3 years it is 9,000. For 5 years, so it's approximately, you can take 3,500, right? Even if you take 3,000, this will become 9,000. This is right. So we can take minimum 3,000 as the free cash flow. There is no doubt about it. So what I do is free cash flow is 3,000 crore per year. If you look at the ROC 30%, it is decent. But if you go here, if you check here directly, here somewhere for 5 years it is growing. Sales growth is 7%. First 3 years 11%. Profit growth is 7%, 8%. So maximum, last 5 years, 3 years it is 11% growth. So we can take 10%. 10% is a safer bet. Last 3 years it is growing at 11%, right? Sales growth. Profit growth is 24%. So it is decent. Okay, it is decent. We can say 12 to somewhere between 10 to 15% it can grow. You should remember this automobile companies, they goes in cycles. Okay, I will talk about it in later. So approximately we can take 12 to 15% the growth. So we'll take safer bet. Okay, let's assume it will grow at 12% growth rate. So discount rate, let's say my expectation is 9%. I'll keep it at 9%, or I'll make it 10%. Okay. So terminal growth, I will leave at 5%. Number of outstanding shares, you can either divide this by this, or you will get this number of equal shares, 20 crores. So I will take 20 crore. Cash, how much cash it has? Cash equivalents is 372 crores. I will give cash 372 crores. What is the debt it has? Debt has 7. It has more debt, 718 crore. Okay. It's quite common that automobile companies carry more debt. Okay. And banks and automobile companies carry more debt. So if I go to ChatGPT, calculate the intrinsic, ignore the spelling, friends, intrinsic value. It will give you the intrinsic value. I think the market cap somewhere will come around, I think 1 lakh crore rupees or less than 1 lakh crore rupees. That is my EV, enterprise value. It come around less than 1 lakh crore rupees. That's what I think. Anyway, I don't know. I could be wrong. Let's see. See, equity value 1 lakh 4,650 crore. So I'm wrong, a little wrong by 4,000 crore rupees. That's okay. Intrinsic value per share is giving 5,233. What is the current price? 5,722, which means Hero MotoCorp is trading at a higher price compared to its value, the intrinsic value. Okay. Once again, friends, this is not a buy or sell recommendation in Hero MotoCorp or NTCS. This is the way we can calculate the intrinsic value of any particular company. So you can use this method to calculate the intrinsic value of any company. So if you make profit, it's up to you. If you make loss, it's up to you. Don't blame me for anything. This is just a explanation to calculate the intrinsic value. I hope that's it, friends. I think you will be able to apply this particular strategy for any other companies in the future. Do let me know if you want to explain any other investing concept. If I know something, definitely I will explain it. We will see you with another video with another useful content. Until then, thank you. See you. Bye-bye.